Imagine a world where the true story of a company's financial health unfolds with clarity and precision. What if understanding these financial signals could empower you to make smarter decisions? Whether you're a student diving into financial studies, a finance professional refining your analysis, or someone simply curious about the mechanics of business success. In our journey today, we will demystify the complex language of financial ratios. We will explore the purpose behind these ratios, learn how to calculate them, and discover why they are essential tools in evaluating a company's performance. Financial ratios serve as a powerful lens to assess liquidity, growth, profitability, and overall return on investment. When viewed on their own, financial statements can seem overwhelming, presenting endless rows of numbers. The struggle many face is how to extract meaning from these figures. That is where financial ratio analysis comes in. By summarizing key aspects of financial performance into digestible and comparable metrics, ratios help us quickly gauge the health and efficiency of an entity. At the heart of this discussion is the understanding that financial ratios are not just numbers, they tell a story. For instance, consider the current ratio, a fundamental liquidity ratio. This ratio is simply the current assets divided by current liabilities. A current ratio of 2:1 is traditionally seen as satisfactory. It suggests that a company has twice the resources at hand to cover its short-term obligations, providing a cushion against unexpected financial challenges. Yet liquidity is only one side of the story. The acid test ratio, or quick ratio, further sharpens our view by excluding inventory from current assets. This ratio, ideally at 1:1, evaluates whether a company can meet its short-term debts with its most liquid assets. When these numbers are out of sync with expectations, they signal potential issues such as overstocking or a looming cash crunch, highlighting the intricate balance companies must maintain between efficient operation and prudent resource management. While liquidity ratios illuminate immediate solvency, leverage ratios reveal how a company finances its operations. Leverage ratios, such as the debt ratio and debt-equity ratio, show the proportion of debt versus equity used by a company. A high debt ratio may indicate that an entity is heavily reliant on borrowing, increasing its risk exposure if market conditions worsen. On the other hand, the debt-equity ratio compares a company's debt with its shareholders' equity to provide insight into its financial stability. Equally important is the interest coverage ratio, which measures a company's ability to service its debt by comparing operating income with interest expenses. When these leverage ratios stray from accepted norms, they warn that high financing costs or unsustainable debt levels may undermine the company's long-term growth. Our journey continues by examining activity ratios, also known as efficiency ratios. These ratios reveal how effectively a company utilizes its assets to generate revenue. The asset turnover ratio, for instance, calculates how much sales are generated per dollar of assets. This ratio not only reflects operational efficiency, but it also serves as a bellwether for a company's overall performance. Similarly, the inventory turnover ratio shows how quickly stock is sold and replenished, while the debtor turnover ratio indicates the speed at which receivables are converted into cash. Additionally, measures like days in inventory and days in receivables help quantify the average duration it takes for inventory to turn into sales and for receivables to be collected. When these ratios are combined, they reveal a company's operating cycle, the complete journey from investment in goods to the collection of cash from sales. Moving forward, profitability ratios provide a window into how successfully a company turns its investments into profits. Among the profitability metrics, return on investment, ROI, stands out as a measure of how much profit an investment generates relative to its cost. Alongside ROI, ratios such as operating margin and gross margin are used to evaluate operational efficiency. return on asset and return on equity, ROE, offer further insights into how effectively a company is using its assets and equity to drive profits. Moreover, shareholder value can be assessed using measures like earnings per share, EPS, earnings yield, and price-earnings ratio, P/E, culminating with dividend yield, which reflects the return provided to investors. Each of these profitability ratios plays a critical role in painting a complete picture of a company's financial performance. However, no tool is without its challenges. Financial ratios, while useful, also have notable limitations. They excel at offering a snapshot of financial conditions using historical data, yet they often fail to capture non-financial factors that might have an enormous impact on future performance. Changes in accounting policies, for example, can skew ratios, rendering comparisons over time less reliable. Additionally, ratios typically do not predict future performances, but rather highlight trends that require context and deeper investigation. As one navigates through these metrics, it becomes evident that ratios serve best as starting points for analysis, tools that must be complemented with comprehensive evaluations to inform sound financial decision-making. Alongside the analysis of individual ratios, comparison techniques play an integral role in verifying the consistency and accuracy of financial data. By comparing similar ratios across different periods or between competitors, analysts can identify anomalies or irregular trends that might suggest data errors or fundamental issues within a company. For instance, when the current or quick ratios deviate sharply from industry standards or historical benchmarks, they prompt closer scrutiny. However, it is crucial to remember that these comparative methods also have their drawbacks. They often overlook non-quantifiable factors and may lead to misleading conclusions when comparisons are made across disparate periods or conditions. The art of financial analysis, therefore, lies in balancing these ratios with broader qualitative insights. The importance of proper ratio analysis cannot be overstated. In failure lies the hidden danger of misinterpretation. Many investors and analysts have mistakenly relied on singular metrics without appreciating the underlying context, leading to decisions that did not fully account for a company's comprehensive financial narrative. By systematically dissecting each category, liquidity, leverage, activity, and profitability, analysts can build a robust framework that not only highlights strengths, but also surfaces potential weaknesses. Imagine a scenario where a company boasts a healthy current ratio, but, when inspected further through the lens of the acid test ratio, reveals an underlying imbalance in liquid assets. Such discrepancies, once identified, can provide early warnings of financial distress or signal operational inefficiencies requiring corrective action. Real-world examples help crystallize these ideas. Consider a company that has maintained a current ratio of 2:1 over several quarters. At first glance, everything appears stable. Yet a closer examination might show that its acid test ratio lags behind at 0.81, suggesting that inventories are fatally weighing down its liquidity. Similarly, a high asset turnover ratio might be celebrated as evidence of efficient asset use. But if accompanied by an unusually high debt level, the overall leverage position might expose the entity to greater financial risk. These examples underscore the importance of cross-referencing multiple ratios for a balanced and nuanced evaluation. As we near the end of our journey, the key takeaway emerges clearly. Mastering the art of financial ratio analysis is not simply an academic exercise. It is a crucial skill that bridges theory and practice. With a clear understanding of the calculations and interpretations behind liquidity, leverage, activity, and profitability ratios, anyone can decipher the critical signals embedded within financial statements. This diligence transforms seemingly disparate numbers into coherent data points that drive better decisions, safeguard investments, and foster growth. In conclusion, the journey through financial ratios is one of enlightenment and empowerment. What began as a confusing maze of figures transforms into a clear map, leading to meaningful insights when approached systematically. By delving into the fundamentals behind each ratio, exploring their interrelationships, and understanding their limitations, you equip yourself to look beyond the surface errors and trends. Now, as you reflect on these insights and consider how they apply to the financial landscapes around you, remember that each ratio is a tool designed to clarify, assess, and enhance understanding. Embark on your own journey of financial discovery and let the power of ratio analysis illuminate your path to smarter decision-making. Subscribe for more financial insights.